for those of you who don't know what Association for Corporate Growth is, it's like the Deal Makers Association, investment bankers, private equity, corporate development officers, bankers, lenders, attorneys, those kind of things. There's 15,000 members and 54 chapters across the globe. And we have a chapter here in Tennessee, and we have one meeting a year in Chattanooga, and I appreciate y'all all coming out and making it a very big success. I do need to just give a nod to our sponsors that we do every time. Bass, Berry & Sims out of Nashville, you know, BDO, Bank of America Merrill Lynch, Forensic Valuation Services are gold sponsors. Silver sponsors, Adams Reese, DeCosimo, R.R. Donnelly, and Vaco. And then what we're going to do is I'm going to turn this over to Andy Stockett, and he's going to, he's got to get his microphone working. And he's going to be the moderator for the panel tonight.
I'd like to thank all of y'all for coming tonight, and especially our panelists who are here to kind of provide some perspectives on what it's like to operate a company under a private equity platform, as well as manage a company from a private equity platform. So I'd like to introduce our panelist. Bob Farnsworth is from Playcore, headquartered here in Chattanooga. Playcore is a leading North American designer, manufacturer, and marketer of a broad range of commercial, playground, park, recreation, performance, specialty equipment, and related complementary products. Bob joined Playcore in 1998 as president of its Game Time division. He became president and CEO of Playcore in 2001, and since that time has successfully completed 10 strategic add-on acquisitions. So I'm not sure if you're the private equity guy here or not, since you know those acquisitions. Prior to joining Game Time, he held senior executive management positions with the Falstaff Company, Hartman Luggage, and Arrow Women's Wear. He serves on numerous community boards in the Chattanooga area, including the School of Business at UTC, Chambliss Center for Children, Chattanooga Chamber of Commerce, and the CoLab. This is probably most interesting I found in getting to know Bob, is that although he sells all this equipment to people across the country, all these municipalities, he actually been on the board of the National Recreation and Park Association for 12 years, including 9 years on the executive committee and 5 years as its treasurer. Talk about the fox in the hen house. I mean, really. So he graduated from Oklahoma State University with a BBA in marketing. Gary Carlson, to Bob's left, is with ATI Physical Therapy. ATI's, I'm trying to give y'all some background as it relates to private equity activity. And ATI operates over 300 physical therapy clinics in 10 states, and they've been through several private equity transitions. As you can see on this slide, it's kind of the alphabet soup of private equity deals, because you got North River, which we decided to call NRPT, was actually acquired by ATI, who was acquired by GTCR, who was owned by KRG. So if you can keep all that in line, you're doing pretty well. Gary was previously, we said, CEO of North River Physical Therapy. At FourBridges, we had the pleasure of working with them on the transaction to sell to ATI. He was originally got a BS in economics from Auburn University, enrolled in Naval Aviation Flight School in Pensacola, graduated as a naval flight officer, and served our country for 7 years. Thank you. Graduated as a naval flight officer, received a master's degree in physical therapy from Washington University in St. Louis, and a doctor of physical therapy from Temple University in Philadelphia. Certified by the American Board of Physical Therapy Specialties as a clinical specialist in sports physical therapy, of which there's only 25 in the state of Tennessee and 1,100 in the U.S. So if any of you have aches and pains afterwards, we'll have a table up in the back for you to see Gary. GenCap, Matt Lane, actually we skipped over, is on the far end of the panel. There we go. Is a private investment firm headquartered in Nashville, specializes in acquisitions and recapitalizations of middle market businesses, actively investing in Southwest Fund LP, a $665 million fund, which began making investments in 2010. Began his career as a CPA with Deloitte & Touche, then worked as a consultant with PricewaterhouseCoopers. Prior to joining GenCap, he was vice president in the investment banking division of Bank of America Securities, and joined GenCap in 2007, has an undergraduate degree from Georgia Southern and an MBA from Vanderbilt. and Daniel Gluck from York Capital Management. Again, a global fund founded in 1991 with $25 billion, that's with the B, under management in both hedge fund and private equity activities. Daniel is a senior vice president, graduate of the Wharton School at the University of Pennsylvania, previously worked at Goldman Sachs under Special Situations Group. Joined York in 2010, focusing on private equity investments. He's spearheading a lot of their efforts here in the Southeast, and originally is from Nashville, and has told me he would love to get some deals done here in the Southeast, so keep Daniel in mind. So welcome, panelists, and thank you for making your time. If you want to frame some things going on in private equity, here's kind of the situation some people think about. For y'all panelists who can't see, there guys around a table says, look, I'm not sure how we came to own your company, but we own it now, so let's just make the best of it. So I'm going to lob a few questions to the panel and then open them up for questions from the audience. Bob, we'll start with you. You joined Playcore when you were the CEO of Game Time, and it was acquired by Playcore. Playcore is publicly traded, but then went through its first acquisition by Chartwell in 2000. What was the transition like from being a publicly traded company to a privately held company, even under a private equity platform?
Well, I joined the company as it was acquired by what is now Playcore, and they were owned by a family prior to that. And I think the main thing is to understand good companies, in my mind, are about the employees of the companies, and really the need to make sure that they understood that transition really, really well. They'd been managed a long time in a very narrow scope, and now they were seeing a different world. And so I think, dealing with the obvious issues from a fiduciary responsibility standpoint, pretty clear. I think the employee side is what most often is missed.
Okay. Gary, can you discuss briefly what led you and your partner's decision to transition the company ownership from being kind of a collegial-owned group to going under a private equity platform?
Yeah, we had been, in our industry, in healthcare, it's kind of vertically integrated over the last, probably 4 or 5 years. We had looked at taking the company and either doing, getting our own capital and moving forward. We knew we needed infrastructure. We also had been contacted by several companies that are PE-backed over the years. Decided to take a look at that and get with FourBridges, and they reached out to the ones that play in our playground. And it's been a good transition for us. We're about 10 months in, and it's been great. So.
I'd like for both Matt and Daniel to respond to this. If you had to generalize across the companies that you come to own or have control in, what are the things you have to most often change post-transaction?
I would say that, I'm not sure I could point to one thing or a couple of things. The way that we typically do it is prior to closing a deal, we come up with a very detailed plan that both we and management put together prior to closing. That way we're all aligned. We know what the goals and expectations are going to be, and we sort of let management run with it, and it's a way for management to know exactly what they should be shooting for, and also a way for us to track them and to track the progress of the company. We tend to probably get a little bit more involved in the things that we have expertise in. The accounting, for instance, you buy a family-owned business, likely they're probably going to need some help in the accounting or in the reporting or in the bank relationships arena, and that's where the things we're good at. The things we're not good at and we don't really have as much expertise in is sales and marketing and vendor relationships. We pretty much leave that to management. But all of those things are put together in something that's very detailed. And we found that the deals we've done the best on are the ones where we've had the most detailed plans, and the ones, some of our earlier investments when we didn't have that, it was very hard to gauge how we were doing for the first couple of years.
I would say for GenCap, our model is not too dissimilar from that. I mean, one of the biggest things we do is we back existing management. So in all of our deals, management has an ownership stake alongside us. So that's one thing, is we make sure management has ownership. The other thing is we'll look at compensation plans and we'll make sure that management has some type of incentive-based comp, and also with the sales force, just try to make sure that their compensation plans are kind of aligned with our goals and objectives.
Okay, Bob, back to you. Can you give an example of how the resources, relationships, or experience brought to the table by a private equity group has helped you through your career?
Well, I think that different equity groups have different skill sets. And, I've had the occasion at Playcore to work with 4 different private equity sponsors, sort of the longest surviving CEO, I think, of private equity sponsors. At least someone told me that the other day. I'm not sure. Mark told me that. But in any event, they come in different sizes and shapes and skill sets. And in some cases, they have strategic services groups within the larger ones that negotiate large contracts across their portfolio companies, which are very helpful and can save companies a lot of money. In some cases, they may have a particular expertise that we would have used. I think the best of them have a portfolio of services and let the companies sort of engage as they feel a need to engage, rather than sort of enforce engagement across whatever they might be trying to do. But they've been very helpful for us. We had a sponsor for 7 years. We just transitioned to a new sponsor about 2 months ago now. And I would say, we worked with that sponsor through 9 acquisitions, and they were very helpful to help with the banking side, particularly of acquisitions.
Thanks. Gary, what are some of the first things that changed day to day once you started working under the ATI platform?
Yeah, what we liked about it is not a whole lot. I mean, my job hasn't really changed. We've offloaded, some things that they do, billing and some electronic medical records and things like that. But we looked hard for somebody that had infrastructure in place and that was managed more hands-off by the PE. Like when we interviewed the different groups, we were kind of looking for that they didn't have a presence at the table, that they were confident enough in their management team to come in and get in and meet with us, and not to say that we just were too far down that food chain. So we wanted to have little or no movement from our current jobs, which is growing the business, moving the company forward, and that's what we've got. And really, it's just a bunch of support. So I always kind of explain it, it's kind of like North River, putting on a large engine. And so it's been, a good partnership for us. So the little interaction we had with KRG was really towards the end game, and it was, but mostly it's been all with ATI upper management.
Yeah, Matt and Daniel, in the early days of private equity, you heard a lot of talk about, LBOs, where companies are acquired and then divisions sold or restructured, and basically returns generated through, quote, financial engineering. To what degree do y'all rely on financial engineering versus getting your returns through operations?
We are not financial engineers. York, more broadly, both on the hedge fund side and on the private equity side, is very conservative when it comes to leverage. I would say across the private equity portfolio, we're probably 30% debt, 70% equity, and I'd say the inverse is true for a lot of our peers. And there's a couple of reasons for that. I think one, we all want to be able to sleep at night. We don't want to have to worry that some hiccup in the economy or hiccup in the specific market the company's in, or you lose one of your big customers and you worry about losing your entire company. We would rather grow the value of the business and generate our return through operating it more efficiently. And our mindset is, let's go in, we have a 12 to 24 month plan. If it works, we'll always use debt as an exit. We can always refinance the business 2 years later when we've grown it to a point where we had always sort of set out to do. And we feel much better that it's operating well enough to where we can take out some conservative leverage and more use it as an exit more than as a way for us to be able to enter the company.
We're the same way, and we certainly have generated some returns via leverage. We use leverage on all of our deals. It's probably closer to 50-50, 50% debt, 50% equity. But the investments that have really worked out well for us are the ones where we've generated growth. And that's really backing a management team and working with a management team on a strategic plan to grow the business. And those are the ones that have really worked out well. So some returns via leverage, but the majority of them that do really well are through growth.
Okay. Bob, back to you. Obviously, when on the last transition that you were acquired by a private equity group, I think a lot of us here in Chattanooga selfishly were glad to hear that it was at least going to be a standalone company as opposed to possibly being absorbed by a strategic. Playcore has been such a great philanthropic platform for Chattanooga, and you personally have done so much in the community. But having said that, how much discussion was there, without getting to specifics or going where we shouldn't go, between, Irving Place obviously needed to make returns. Is there much discussion about strategic versus private equity, and how does the management team, are they able to factor into those decisions?
I think when you, at least when we went into our process, which was a real thoughtful process from management, we really were very neutral on the subject on whether it would be private equity versus strategic. And that's not easy to say, because obviously private equity usually allows management a much stronger position in terms of creating a personal value than maybe strategic partners might have. But our focus needed to stay on building a great company, not necessarily the financial structure of the company. And so, as management has to have that kind of view, we started out very neutral. And I think there's benefits that sit on both sides. We'd worked hard with a strategic partner. Some of you in the room have worked on it with us to merge with a European counterpart strategically. I think that would have been a great outcome, but it wasn't the outcome that took place, and we're very happy as well that it ended up with a great private equity sponsor that continues to support the mission, value, and direction of the company. So I think it's really about what can help build the company to a better company long term.
Okay. Gary, a lot of times when an owner-entrepreneur has a transaction, they have the opportunity to roll equity into the acquirer with the expectation of getting a, quote, second bite of the apple. Again, without getting into too many specifics, you were allowed to roll some of your ownership. Can you comment on how you decided to do that and what drove that decision?
Yeah, I mean, we were allowed to, I think, pretty much roll whatever we wanted to. And so we looked at, just had counted on us doing our homework prior to, which was about a 5-year process. So we thought we had a good platform that we were partnering up with. So we rolled as much as we could. We just looked at it from how much do you want to take off the table, and not that they're, I'm the little fish in this pond up here, so it wasn't like we had, there was a lot to, it wasn't a huge deal or anything like that, but we, had to look at, what do we want to take off the table right now, what do we want to roll, and how confident were we that going with the new company, can we move that forward and move that needle and see where we're going to end up.
And what is kind of interesting, if you look at the chart up there about the ATI platform, is that I think, Gary, you can correct me if it's right, but I think in 2005 when ATI was acquired by KRG out of Denver, I think they had something like 50 clinics or something like that, and they grew it up to, say, 100 or more clinics, and it was acquired by GTCR in 2010. At that time, or in between that time, 2010 and 2012, KRG actually went out and raised another fund of like $750 million. And to hear them say they were looking around to see where they're going to deploy their money, and they said, we still think physical therapy is a great platform. We think all the drivers are still there, and we know the guys, and so they just bought it back. So
yeah, and I think a lot of what drives that in our industry, just healthcare is a pretty fragmented industry as a whole. Physical therapy would probably be just as much. So any of the major players in our particular industry, no one owns more than 6% of the market share. So it's very, very fragmented, and so I think that's why you'll see over the next few years a lot of vertical integration with it.
Matt and Daniel, can y'all quote on owner-entrepreneurs rolling equity, and is that always a requirement, or do you have thresholds that you like to see? And
yeah, it's a requirement for us that management has ownership. A lot of the deals that we do are kind of founder-owned, family-owned companies where the owner is really ready to step aside and realize a liquidity event. And in those deals that work for us, it's where he's kind of groomed a team underneath him to take over the operations for us. So most of the deals we're doing, that kind of has that scenario where the owner is retiring, but there's a team underneath them. They're going to take an ownership position alongside us. But in some of those deals, the owner does roll money. It's not a requirement for us that the owner rolls, but it is a requirement that the management team who's going to be running the day-to-day operations has an ownership stake alongside us.
I'd say we have a pretty similar philosophy. We just did a deal, a large deal. We bought a chain of health and fitness clubs out in California, and the management team owned about 20% of the business. They cashed out about a third of it we bought it from another private equity fund, and they cashed out about a third of what they owned, just because they were pretty illiquid, and on paper they were worth a decent amount of money, but they wanted a little bit of cash to be able to buy a slightly nicer house or pay for their kids to go to private school. But other than that, they wanted to roll the remainder, and it's very important to us. It's how we align ourselves with the management team. We have another company where the two guys is a founder-owned business. Had been running for 12 years. Two guys. We bought majority control. They didn't take anything out of the business, and there was a whole negotiation over what were the governance rights going to be. And they didn't really care about our ability to fire them. They cared about what happened to their equity. And what actually ended up happening was we had an agreement. The CEO, the company was based in Florida. The CEO lived in New York. It was just hard for him to be the CEO, flying down for commuting down for maybe a week or two a month. And so he sort of stepped back and said, what, I don't care about being the CEO. My equity value in this company is worth a lot more than what I'm getting paid as a salary for the CEO. So he moved on to the executive chairman role, and that's exactly the mentality that we wanted our managers and owners to have. Is he cared much more about his equity value than he did, about the couple $100,000 a year that he was making as the CEO running the business.
Can you maybe elaborate? So if the owner or entrepreneur is actually, say that we see a lot of these companies where they're at retirement age and they really want to hand the keys over, and that second management team comes in and maybe they didn't have a lot of their own equity, what kind of equity incentives? I know it can vary by situation, but you kind of walk through how you typically do that to get that second layer of management, which is becoming the new layer of management. How do you keep them incented and shoulder to shoulder with you?
Sure. And by the way, I should have mentioned a management investment is our single greatest due diligence mitigator, because if management doesn't want to invest, then that's a huge red flag for us, because we recognize that in 90 days of due diligence, we're not going to uncover things that the management team has seen for 10, 15, 20 years. So it's critical to us. And the way we do it, we structure it, it's kind of a unique structure. We put a lot of our money in front of the equity as either sub-debt or preferred stock. So what we do is we kind of shrink the equity component, which allows management to own a more meaningful stake without a huge investment, because we recognize in a lot of these cases where it's family-owned, founder-owned businesses, the second tier of management they don't have millions of dollars of liquidity, so we have to put in place a unique structure to make it work for them.
And we do something similar to that. We ask our managers, even if it's the second layer of management who's going to become the leaders of the company, to put in something. And a lot of times what we'll do is that something will invest pari passu to our investment, and maybe they'll get double the credit. So if they put in $100,000 or $200,000, we'll give them credit for $200,000 to $400,000. And then that once we get our money back, or our money back with the return, something like that, they own 10 to 25% of the upside, depending on the deal, depending on if it's one person versus if it's 10 people. That's typically the structure for management that is going to be running the business but is not already an owner, or might be a very small owner upon our entry into the company.
Okay, just a couple more and then we'll open up some questions. Bob, a lot of times we hear about the 5 to 7 year hold period for a private equity portfolio company versus, say, a strategic buyer. Is there any way that so-called ticking clock works its way into operations and management's perspective?
I think it kind of depends on, the scenario that you're wanting to think down. We kind of like to think through multiple scenarios. So, we're not thinking about a 5-year or 5.5-year exit strategy. We are very focused on organic growth as well as acquisition growth. And so, if we can speed up the acquisition growth, we might look at a very shortened cycle for return, given that we'll buy things typically at a much lower multiple than what the company will see on an exit strategy as we might turn. So, it depends on the appetite of the private equity group in terms of what their thoughts are. If they're aggressively acquisition driven, then it might be a shorter cycle. If they're highly dependent on organic growth, it's going to depend much more on the economy. So we kind of make sure we understand the scenario that might play out, and then we sort of operate along a multi-scenario strategy so that we don't have one focus on one exit period or whatever. So in the case of our company, we may have a very aggressive acquisition plan over the next few years. Hopefully, we'll have a very aggressive acquisition strategy. Like I said, we acquired 9 companies over the last 5 years. I suspect that'll escalate a little bit. And so that really drives a much shorter outcome probably at the end of the day.
Okay. Gary, a lot of times when we represent owners and entrepreneurs, in addition to just the monetary outcome of the deal, there's a lot of emotion in there knowing it was their baby and they started it and nurtured it and all those kind of things. From your perspective and your partners, do you have any feedback? And this is one of the things, like what's going to happen to my company, what's going to happen to my customers? Any feedback from patients or customers since you've gone from a, quote, independent, locally owned to a bigger platform?
No, I think we lined up really well philosophically with ATI. So like I said, it's been really seamless. I think we wanted to look out for our employees. That was the first thing. They got, a lot better benefit packages. Some of the incentives that these gentlemen were talking about lined up for some management. It was, so everybody that's come in has said, hey, there's really the only thing that's changed is what you're wearing and the name on the outside of the building. And that was important to us from the get-go because we'd built it, off of, a local company. So we wanted to keep it as much mom and pop as we could, and that's what we've been able to do.
For Daniel and Matt, we see a lot of private equity groups promoting relationships with, quote, operating partners that are specialized in certain industries. These might have been people that you previously owned their companies, and now they're actually become investors in your funds, but they're there for bench strength or whatever to help your portfolio. So they may have specific experience as CEOs or CFOs, and that can be positioned as a value add to the management team. That have either of your funds embraced that concept, either formally or informally?
We haven't in the way that a lot of our peers have. We don't have a Rolodex of people that are on the payroll that are either in specific geographies or in specific industries. We're generalists, and the nice part about being a private equity fund that's within a hedge fund is I call it private equity with a hedge fund mentality. So we're generalists, we're capital structure agnostic. We're just looking for interesting deals, and the way that we typically do it is to the extent we need to during the due diligence process, we can always find somebody to bring in to either help us with due diligence, to be a part of the management team if the management team needs any sort of augmentation, to be on the board of directors. One of the things that we find is management teams of family-owned and operating businesses, they're fantastic managers, but they may not have any sort of M&A experience. And when we're going into a business, we're trying to grow it, and a lot of times you may have to bring that expertise in. And that's where it's helpful to be able to find somebody who has industry experience during our due diligence process to be able to work with us on projects like that.
Our model is similar to that. We're not an operationally focused fund. We back existing teams, so we do not use operating partners. With that being said, oftentimes because we're acquiring these small family-owned businesses, we do need to augment the team, and that's usually with a CFO or a controller, because a lot of times the way these companies are run, there's not a lot of financial sophistication there, and the level of reporting and just financial wherewithal that we need is a little more than kind of how an owner-operator has run it. So, and I don't know, maybe a third of the companies that we acquire, we do end up hiring a CFO or controller to kind of round out or augment the team. But operating partners, we don't use those.
Okay. Last thing I think I'd like to bring up is there's some private equity metrics out there that we pulled up. There's almost 3,000 private equity firms headquartered in the U.S. 320 buyout growth expansion funds are currently out there fundraising. $443 billion of private equity investments were in U.S. companies last year. And in Q1 alone, 2014, $110 billion in the U.S. private equity investing, $33 billion fundraising, 412 estimated global buyout fund, quote, dry powder, and $49 billion of U.S. private equity exits in Q1 alone. So obviously there's a lot of stuff going on, going in and going out. Matt, Daniel, can you kind of comment on what the, quote, so-called market conditions are? Let's say July of 2014 versus July of 2013.
If I could find an adjective better than frothy or hotter than frothy, I would use that. It is very competitive at kind of the top of the capital structure. I mean, the lenders in here would tell you the same thing, from senior lending all the way down to the equity. It's everything is priced very high. So it's quite frankly a great time to be a seller. If there are any business owners in there and you're thinking about exiting, now is a perfect time, because market conditions, I don't think they've been higher than they are right now.
That's funny. You stole my line. I was going to say, anybody in here who's looking to sell this, and this is not an advertisement. You should hire Andy, and you should go to market today.
Business cards.
Who knows how long this is going to last? But it's like I think that some of our peers may have lost a little bit of discipline and forgot what happened 5 or 6 years ago. And I think that they can't help themselves. When you're being offered 6 times covenant light leverage at relatively attractive interest rates, it's very hard to pass up. And as a PE fund, you have to put the money to work. I think discipline for some people has gone out the window a little bit. And we don't think this is going to end well, but maybe that'll be good for us. And I don't know whether it's going to be 2 or 3 or 4 or 5 years, but at some point you're going to have a lot of very good businesses that were just over levered, and hopefully we'll have the chance to evaluate some of those opportunities then. And what we're looking for now is we've had to get a little creative, and we're looking for owners or managers who aren't looking for the big exit now, who really think there's growth in their business and who just may not have the capital to do it. And are looking for, maybe for somebody to come in to A, provide the capital, and B, to sort of provide the institutional investor that will help them in the big exit later on. Because, sort of buyouts of very, good growing companies right now, it's insanely competitive, and the prices that are being paid are very, very high.
With that, open it up for questions.
I wonder if you could talk about post-closing surprises and how along the way that may have changed your approach, having that experience. So many transactions between the 4 of you, maybe lessons learned along the way that have maybe changed your due diligence process or style of communication with portfolio companies or advisors with private equity sponsors.
I think that Warren Buffett said it best, and you read about him, in business school, and management is the key. Well, it really is the key. And the most time that you can spend with management, touring the facilities, grilling them on the financials, on all of the numbers. One of the things we've actually implemented into our pre-closing checklist is, have you spent time with management socially outside of the office? We've had a couple of deals where we're great companies, but there have been red flags when you take a manager out for a couple of drinks, and it starts to become a little bit of a looser conversation. management is one, and then the other is when you're trying to grow a company very aggressively, training plays a huge factor. And you really need to make sure that you have the infrastructure in place to train new employees. And the companies where we've been the most successful at growth are the ones that have that in place. And the ones where we haven't done as well are businesses that have been running at 100 employees for the last 10 years, and they've never had to grow. And they don't really know how to bring in another 100 employees and get them trained up very quickly.
I think one of the other things that, we've acquired quite a few companies that has really changed in terms of due diligence processes is that the list is really expanded. If you're not doing due diligence on website management, SEO optimization, all those types of things on companies, you'd be buying into a high-risk situation where a server crashing might take a business down for 3 or 4 months. IT due diligence becomes really, really critical. And I find most private equity groups are not necessarily doing a lot of due diligence on intellectual technologies. Patent infringement issues, patent law changed here recently. If you're not doing due diligence on whether or not their patents are current with the current legislation on patents, so there's a lot of areas that, we didn't really think about in terms of due diligence, and there's expense attached to it. We were doing due diligence on acquisition. We're trying to finish in August, and learned that their servers were being managed inappropriately. So there's a lot of things that the technology side of companies really are non-traditional to the due diligence that you would have seen, 10 years ago.
Any other questions?
Maybe this is a question more for Matt, but also Daniel, if you want to chime in. You mentioned, Matt, that when you do a deal, normally you bring in some financial sophistication, but are you usually making a bet on the existing management strategy, or do you bring any other expertise in to help accelerate your growth?
Usually the strategy, we're backing the existing management team strategy. So we'll bring in finance just kind of with financial reporting and certain analysis that we'll need. But as far as backing the strategy, it's the existing teams kind of in conjunction with us. We work with them similar to what Daniel said on the front end before we make the investment on kind of the 12 to 24 month strategy. What are we going to do? How are we going to grow it? But it's the existing team. We're not bringing in external consultants, if you will, to help us with that.
Any others?
Question for Bob. I know you mentioned employees early on in your comments, and that's a really important area. You've been through a number of transitions with private equity firms and also done a number of acquisitions. How do you manage culture in all of those transitions?
That's a great question, because to me, really it starts with culture and the people. It may be management teams and backing management teams, but if those management teams don't know how to manage people, then I don't think you're going to be real successful. So really, it's the first screen out. I visit all the targets myself personally to get a feel for culture and what's there, what's the work pace, what are the things, are they going to integrate into an aggressive. We're a very aggressive outcome-based company, and if that's not going to fit well because they've got too much of a colloquial kind of approach to their business. So I think it's really, really important. Secondarily, we don't do a lot initially. We like to acquire companies, and we like to watch them for 6 months. And we like to really understand what their thoughts are in the business, learn from them. We have an approach in our leadership style towards humility, and we like to not imagine because we're a bigger guy that somehow we know more than the people running the business. We could say that of a few private equity guys I know. But in any event, we don't want to take that over. And I think learn about their culture a little bit, and we've got to make sure we're very adaptable to multi-cultures. Playcore owns a bike rack and bike storage urban company in Minneapolis. These guys all bike to work. It's a little gamey in that office by the time I get in there. And they have dogs, by the way, in the office. And so how does very, very straightforward Southern corporation like Playcore, adapt to the culture that they have locally. So we work really hard on not imposing our culture on the acquisitions, but trying to understand how we can integrate their culture into our workplace.
I think in the interest of, well, okay, one more question.
Sorry. For Matt and Daniel, for those companies that would have liked to attract private equity, but you turned them down, what are the key things that they could have done differently that would have made them more attractive to you?
The biggest thing we've seen, if the company kind of fits our parameters in terms of size, industry, and geography, a few other things that we look at, the biggest thing we see is a lack of succession plan. We oftentimes will look at a business, and the situation where I mentioned earlier, we're looking at an owner and he's groomed a team underneath him. A lot of these we look at, the owner is the business, and without the owner, you're really, you're just buying some receivables and inventory, because once he steps away, there's nothing left. So what we've seen, the biggest mistake we've seen business owners make is not having a succession plan and not grooming a potential successor or CEO to take over his position when he's ready to exit.
Exact same for us. We actually looked at a business based here in Chattanooga that's a fantastic business. It seems to be a fantastic business when you look at the numbers and what they're actually doing. We went, we visited, and we took a tour of the office with the owner. And literally the owner, hugged and kissed every single employee in the entire company as we walked around. And there's just no succession plan. His son works there. His son is, I don't think he's the president. I don't think he's second in line. But there is no second in line. And we thought about it for a very, very long time. And I just don't think that we could bring outsiders into a business like this and continue to operate it with the culture that they have that's really built around this one guy. That was the feedback that we gave to him, and we remain in touch, and hopefully things will change in the next couple of years, and it will be something that would be able to attract institutional capital.
I think we're going to wrap it up, and we'll have have a chance to network afterwards, and if y'all can stay around for just a little bit, if you've got something pressing, we understand, but maybe if you've got some follow-on questions, you can nab one of the panelists afterwards. But thank you all once again for making the time to come visit with us, and I'll let Chris wrap us up.
I want to thank everybody for coming. Just want to let you know we've got the food and the drinks, I believe, might be right outside. We moved the tables over into Seahorse, something. I'm not exactly, I know what it is. But you're also welcome to take self-guided tour. You go up the escalator to the left, go through. They have a brand new otter exhibit. We've got this place for the evening, so they'll have a great time. The next meeting for ACG is in Nashville on August 19th. And then for you people who are guests, we encourage y'all to think about joining. It gives you access to the Atlanta meetings as well as the ones that are in Tennessee. And next year, I think we're planning on doing a member-only meeting, and maybe using the aquarium's boat and heading down through the gorge in, say, October with a colorful change. So I think it'll be a real nice thing to do. So thank you very much for coming. Appreciate it.